Good morning, and welcome to the American Enterprise Institute and our program on Federal Reserve reform. My name is Paul Kupiak. I'm an AEI scholar specializing in financial services. Today's Federal Reserve is not your great-grandfather's Federal Reserve. Over time, the U.S. Congress has expanded the Fed's mission, objectives, and powers as it has asked the Fed to manage new challenges facing the U.S. economy and in some cases to solve problems that were more imaginary than real. In 1913, Congress passed the Federal Reserve Act to, and I quote, furnish an elastic currency to afford means of rediscounting commercial paper, to establish a more effective supervision of banking in the United States, and for other purposes. After 105 years of Fed operations, in hindsight, I think it's fair to say that among these objectives, other purposes turned out to be the most important. To accomplish its original mandate, the Federal Reserve member banks could augment the reserves of member banks by rediscounting the bank's short-term commercial and agricultural loans with their regional Federal Reserve Bank. The Fed's discount window was the primary means by which the Fed added elasticity to the nation's money supply, a feature the 1913 Congress thought would, once and for all, put an end to banking crisis. In the early days, the Fed was limited to discounting short-term paper, loans up to a few months in maturity, and the Fed was only allowed to rediscount collateral for Federal Reserve member banks. This limitation proved problematic during the panics of 1929 and the early 1930s. In December 1925, fully 65% of the commercial banks in the United States had no access to the Federal Reserve's discount window. In July 1932, Congress passed the Emergency Relief and Construction Act, which authorized the Federal Reserve to, and I quote, in unusual and exigent circumstances, to discount for any individual, partnership, or corporation notes, drafts, and bills of exchange of the kinds of maturity made eligible for discount for member banks, provided the Federal Reserve shall obtain evidence that such individual partnerships or corporation is unable to secure adequate credit accommodations from other banking institutions. So this is the famous source of the power in exigent circumstances. More Depression-era legislation followed. In 1933, Congress passed the Glass-Steagall Act. Besides separating commercial and investment banking, the act created temporary federal deposit insurance and gave the Fed a new power to control the interest rates banks paid on customer deposits. Regulation Q prohibited the payment of interest on demand deposits and allowed the Fed to cap the interest rate banks pay customers on other deposit products. In 1935, the Banking Act gave the Fed the ability to buy long-dated government and treasury bonds and notes, something it didn't have the power to do before. It also established the Federal Open Market Committee to coordinate interest rate policy among the 12 Federal Reserve banks. It made FDIC deposit insurance permanent and allowed any non-member bank with deposit insurance access to also have access to the Fed's discount window. These changes, deposit insurance and the new Fed lending authorities, were probably the key changes that helped end the banking crisis of the Depression era and usher in a long period of banking sector stability. In 1948, the Federal Reserve sued Transamerica Corporation, a bank holding company that had effectively created an interstate bank by owning banks in several adjacent states. At the time, interstate banking was not permitted by law. The Fed sued to break up Transamerica under the Clayton Act, but it lost in court. In 1956, in response to this, Congress passed the Bank Holding Company Act to give the Federal Reserve Board the power to prevent interstate banking by restricting the expansion and activities of bank holding companies. It also separated banking from commerce. In 1978, Congress passed the Humphrey-Hawkins Full Employment and Balanced Growth Act. The act required the government, including the Federal Reserve, and I quote, listen to all these objectives, adopt effective policies to promote full employment and production, increased real income, balanced growth, a balanced federal budget, adequate productivity growth, proper attention to national priorities, achievement of an improved trade balance, and reasonable price stability with maximum reliance on the resources and ingenuity of the private sector of the economy. That's quite a mouthful that the Fed has to do. In 1999, in the Financial Services Modernization Act, also known as the Gramm-Leach-Bliley Act, the Congress repealed the Glass-Steagall requirement of separating commercial and investment banking, and it gave the Federal Reserve regulatory responsibility over newly created financial holding companies, which were companies allowed to own commercial, investment, and insurance companies. In 2008, to counteract the financial crisis and recession, the Fed pegged the federal funds rate near zero and used its existing powers to expand the set of tools it uses to conduct monetary policy. It began paying interest on bank reserves and made massive purchases of mortgage-backed securities and treasuries in its quantitative easing program. In 2010, the Dodd-Frank Act, Congress officially added financial stability to the Fed's list of mandates. However, in doing this, the Congress failed to define what it meant by financial stability. The Dodd-Frank Act also created a new Financial Stability Oversight Council to identify financial institutions that are systemically important. Once so designated, the institutions were placed under enhanced supervision and regulation scheme managed by the Federal Reserve Board. Beyond this extensive list of legal mandates and powers, some might argue that the Fed should also consider the impact of monetary policy decisions on the nation's wealth distribution. And because the dollar is a global currency, that Fed policy should place weight on the international impact of its monetary policy decisions. As you can see, even though my history is far from exhausted, over its 100-plus-year history, the Congress has given the Fed quite a long list of objectives, tools, and regulatory powers. Moreover, since the Federal Reserve Treasury Accord of 1951, the Fed has been an independent entity whose operations are not subject to control by the U.S. Treasury or the executive branch. Federal Reserve Board governors and its chairman are nominated by the President and confirmed by the Senate, but in theory, once they are confirmed, Fed governors direct Federal Reserve operations independent of political pressures to carry out the Fed's legal objectives, subject only to oversight by the U.S. Congress. Today, we are honored to have Representative Andy Barr join us to discuss changes that the U.S. Congress is considering in the laws that govern the powers and responsibilities of the Federal Reserve System. Andy Barr is a Republican from Kentucky and has served as the U.S. representative for Kentucky's 6th Congressional District since January 2013. He is a member of the Committee on Financial Services, and he is chairman of the Monetary Policy and Trade Subcommittee. Congressman Barr earned his bachelor's degree in government and philosophy from UVA and his law degree from the University of Kentucky. Please join me in welcoming Congressman Andy Barr. Good to see you. Thanks for coming, Congressman. Thank you very much. Yeah, glad you could join us today. So there's method in this long introduction madness where I wanted to go through and remind everybody of all the things our Congress has assigned the Federal Reserve to do. So I guess my first question is, do you think an informed citizen, just following the news, actually has the ability to understand all these laws and assess whether the Fed is actually doing a good job meeting, its congressional objectives?
No, very simply. The public doesn't have the capacity. There's a lot of opacity in the Fed's conduct of monetary policy. Our reform efforts try to remedy that problem. But I think the laundry list of statutes that you cited in your introduction are important to revisit here because it reminds us as the self-governing citizenry that the Congress, the elected representatives of the American people, created the Fed in the first place and assigned to the Fed its statutory responsibilities. This notion of Fed independence and this idea that the Fed, we should never ever contemplate congressional intervention in Fed decision-making or Fed authorities is anathema to the actual origins of the Fed. Not just the Federal Reserve Act, but all of these subsequent statutes through the Humphrey-Hawkins Act and some of the more recent congressional actions, the Fed's responsibilities, their statutory responsibilities and duties, their authorities, all of it derived from congressional statute and congressional delegation of responsibility. So this idea that our reform agenda is is unwise runs counter to the fact that the Fed is a creature of Congress. So we want the Fed to conduct monetary policy in a more transparent way, a more accountable way, a more predictable way. And we certainly have the prerogative and responsibility to continue to provide that additional transparency and accountability to the Fed and improve its decision-making accordingly so that there isn't this opaque misunderstanding or lack of understanding by participants in the economy. The goal, and I'll just conclude by making this point, the goal of our efforts with respect to oversight of the Fed should not be Fed independence. The goal should be optimal economic performance. And if we're not getting optimal economic performance, if goods and services, including labor, are not flowing to their most productive uses because of a lack of clarity in monetary policy, then we ought to improve Fed decision-making and transparency and accountability to achieve that ultimate objective.
Congressman, thanks for that. I believe you sponsored a bill, H.R. 4270, Monetary Policy Transparency and Accountability Act, and it passed committee, and I think did it pass the House?
No, it has not. It has not. Now, a version of it did pass the House in the last Congress under the Form Act.
Could you explain a little bit what this bill does and how it helps in this regard of transparency of Federal Reserve operations?
Absolutely. Some have called this the imposition of a mechanical rule or the Taylor rule or some other requirement on the Federal Reserve. That is not the case. That is a misguided criticism of the legislation. We simply want the Federal Reserve to abandon its past decade of unconventional, improvisational, economics-free decision-making with more predictable decision-making. And basically, this bill is a communication requirement. This bill requires the Fed to articulate and clearly communicate a monetary policy strategy. And that can be achieved by identifying a rule that the Fed intends to follow and communicate some reference rules that are different than the rule that it's identifying, and to communicate how monetary policy trajectory would change if it was pursuing alternative reference rules as opposed to the selected rule. And then to the extent the Fed decides to deviate from the strategy or the policy path that it has chosen, it needs to clearly communicate why. So the Fed routinely today, and in the past, Chair Yellen would often say that our policy is data dependent, but it doesn't. But they have failed typically to say what data matter and how it matters. And so again, we think this would enhance communication. And why is that important? Because it allows market participants to have greater certainty about where Fed policy, interest rate policy is going, so that market participants can more efficiently allocate resources, households and businesses. Again, this is not compromising Fed independence. This is not dictating a mechanical rule or handcuffing the Fed to follow a particular rule, the Taylor rule or any other rule. It simply requires the Fed to articulate a strategy. If it deviates from that strategy, to explain why it's deviating from that strategy. And even though this legislation did not become law as part of the Form Act and has not yet even received a vote in the full House, the fact that we've introduced the bill has made a difference. If you look at the semi-annual report from the Fed, and I've got a copy right here, obviously this monetary policy report is published twice a year by the Board of Governors. And the last one, February 23rd, 2018, on page 35, you can just thumb through here, and they have done the Fed has done what they haven't done in the past, which is to actually publish 3 pages, monetary policy rules and the role in the federal policy process. We're actually making a difference even though we haven't passed a bill, and I think that's an important point.
I think that's a hugely important point, that when Congress asks questions, the Fed reacts, even if legislation isn't necessarily passed. Just for example, to make that last point a little concrete, maybe the Fed would have a plan that if unemployment rate would get very low, they would follow a path of rising interest rates, but the rising interest rates might have impact on emerging market countries and cause currency problems there. And as it stands now, my impression is the Fed could modify their policies to do objectives that really aren't in their legal objective, but sort of obfuscate that fact by pointing to all kinds of opaque language of why they deviated from the rule. And my impression is that the Congress just says, we want you to tell us what you're really doing and why you're really doing it, is the whole point.
That's right. And it goes back to your original question. Do the American people, do participants in the economy really understand what the Fed is doing? We think this bill would dramatically improve market participants, households, businesses, to better understand the thinking of the Fed and the projected path of monetary policy. And as opposed to this unconventional policy, untethered to any kind of strategy, the wild improvisation of quantitative easing and swinging from this policy and that policy and entering into the credit allocation space. Instead of that kind of unpredictable improvisation, market participants will have a clear idea of where we're headed. I want to just actually compliment the Fed in the past few years because they have at least stuck to a course. I think right now, even in the absence of legislation like this that would guide the Fed's decision making and their communication, I think market participants generally understand where the Fed is heading right now, but I think this would improve in the long run Fed decision making and communications from the Fed.
So, Congressman, I have a whole list of questions, and I could talk to you for hours, but I can't because I know you don't have all day to spend with us, unfortunately. So I want to give the audience some time to ask some questions. So let's take some questions for the Congressman, and please state your name and your affiliation, and please no speeches, just get to the question. So wait for the mic right here, Bert.
My name is Bert Ely. I'm a banking policy and monetary policy consultant here in Washington. And thank you very much for being here with us this morning. I have a question for you in terms of what concerns you might have as to what the longer-term impacts, potentially negative impacts, are of the sustained period of very low interest rates, and particularly the impact on life insurance companies, pension funds, and asset prices.
Well, thanks for the question. Obviously, there is some evidence that an extraordinary, protracted, accommodative policy can produce asset bubbles. And there's been quite a bit of commentary about how Fed policy contributed to the housing bubble in the run-up to the financial crisis. And I think that is something that, again, I think that's a risk of unconventional monetary policy. I think the massive balance sheet, I think the Fed's foray into credit allocation has created a lot of distortions. And that's why it's very welcome to see the Fed pursuing a normalization strategy, pursuing a balance sheet reduction program. We want to see that balance sheet reduction because this is unprecedented. That unwinding process to be, the pace to be predictable. The taper tantrum got a lot of people nervous. So far, it looks like the Fed is generally following its strategy. But one thing to look at is Chair Yellen articulated the pace of normalization and balance sheet reductions. But because interest rates are rising, the amount of mortgage-backed securities that are naturally maturing is adjusting and slowing down. So there's a question about the balance sheet reduction strategy and whether or not the natural maturities can keep pace with the communicated reduction plan. But certainly, when the Fed moves into an extraordinary, unconventional path like quantitative easing, when it buys mortgage-backed securities or other non-treasuries, distortions are created because it gets involved in allocating credit, picking winners and losers in the marketplace. That is a dangerous precedent. And that's exactly why in our reform agenda, we not only promote independence from credit allocation, but we require greater congressional approval of emergency lending and other type of unconventional activities.
Down in front here. Yeah. Wait for the mic, please.
Member of Parliament, so my view is as having been a politician as well. It seems to me, especially listening to the list of objectives for the Fed, which we were presented with, why not simply reduce have an entirely new Federal Reserve Bill in which you both repeal a great deal of legislation and narrowly define the objectives of the Fed. That would, dare I say it, follow the pattern in very many other countries in the world. Why not consider that a much more clearer statement of the objectives, and that in itself wouldn't that not in itself lead to greater accountability?
Absolutely. And again, our objective with monetary policy should not be Fed independence. It should be price stability. It should be maximization of economic performance. That should be our objective. And the more responsibilities that are delegated to the Fed, the less clarity there is, the less price stability, the greater the likelihood that there will be price instability. So think about what Congress has done over the years in amplifying and expanding Fed authorities and responsibilities. It's not just a dual mandate anymore. Arguably it's a triple mandate, a quadruple mandate. After Dodd-Frank, they added an additional responsibility for the Fed to monitor financial stability. So it's not just full employment and price stability. It's also financial stability and interest rate outcomes. So at the end of the day, we've added to the fog, the policy fog, if you will, and nobody really understands what the Fed's job is or what the monetary policy objectives are or the strategy or anything. So you're right. There are members of Congress who have proposed eliminating the dual, triple mandates, what have you, and return to the single mandate of price stability. I happen to like that idea a whole lot. But at the end of the day, on our policy agenda, we recognize that we want to make as much progress as we can. And if that means taking modest steps to move us in the right direction, and do what is politically achievable, we think we should take those opportunities and not let the perfect be the enemy of the good. One reform that I think is perhaps bipartisan or could achieve bipartisan support and something that we should move on very aggressively is especially in the aftermath of Dodd-Frank, where that law conferred a considerable amount of additional responsibilities on the Fed in the supervision space, in regulatory authorities. The Fed is not just in the business of the conducting monetary policy. The responsibilities are wide and deep with respect to supervision and regulation. And I think that is in the realm of fiscal policy. It should be accountable to the American people through congressional oversight, meaningful congressional oversight. And that's why we support in our policy reform agenda subjecting the Fed supervision and regulatory activities to the annual appropriations process. Now some would say, well, you're compromising Fed independence. I totally disagree with that. We're not talking about monetary policy. We're talking about Fed regulatory and supervisory activities. Other financial regulators are subject to the congressional appropriations process. We need to subject the Fed to the congressional appropriations process with respect to its supervision and its regulatory activities.
One of the unfortunate aspects of my job is I have to pull the punch bowl away because I have to get the congressman back up to do his daytime job. So join me in thanking Congressman Barr.
Thank you, Dr. Kupiak. Thank you very much.
Thanks a whole lot.
Thank you. Thank you very much.
Thanks for coming down.
Thank you.
Okay, we have a little halftime break while we change the stage. We don't have cheerleaders or dancers to entertain you. But what I'll do in the meantime is I will introduce our expert panelists who will now be taking the stage as soon as we change the stage. Take that for a minute. Our first speaker on the panel will be Professor Peter Conti Brown, who's an assistant professor at the Wharton School of the University of Pennsylvania. He's a financial historian and a legal scholar. Peter studies central banking, financial regulation, and public finance, focusing on the histories and policies of the U.S. Federal Reserve System. He's the author of the book, The Power and the Independence of the Federal Reserve, which was published in 2016 by Princeton University Press. He's the editor of 2 other books and the author and co-author of a dozen articles on central banking, financial regulation, and bank corporate law. He received a law degree from Stanford Law School and his PhD in history from Princeton. Speaking second today is Aaron Klein, who's a fellow in economic studies and the policy director of the Center on Regulation and Markets at Brookings Institution, a sister think tank down the street. He focuses on financial regulation and technology, macroeconomics, infrastructure finance, and policy. Previously, Aaron directed the Bipartisan Policy Center's Financial Regulatory Reform Initiative, and he served in the Treasury Department as a Deputy Assistant Secretary for Economic Policy. He serves as Chief Economist of the Senate Banking, Housing, and Urban Affairs Committee for Chairman Chris Dodd and Paul Sarbanes. He is the co-author of Thomson Reuters' FinTech Law Report. He's a graduate of Dartmouth College and the Woodrow Wilson School of Public Affairs at Princeton University. And I believe Alex Pollock is also a graduate of that institution. Our third speaker, George Selgin, is a senior fellow and director of the Center for Monetary and Financial Alternatives at the Cato Institute and professor emeritus of economics at the University of Georgia. Cato, of course, is another sister think tank down the street. George specializes in monetary economics, including monetary history, macroeconomic theory, and the history of monetary thought. He's a founding member of the Modern Free Banking School. He's author of numerous scholarly articles and also made contributions to popular press outlets such as the Christian Science Monitor, the Financial Times, and the Wall Street Journal. He has a BA degree in economics and zoology, which is a good combination, I think, from Drew University, and a PhD in economics from New York University. Our final speaker on the panel is Alex Pollock. He's a distinguished senior fellow at the R Street Institute, another sister think tank. He previously was a resident fellow at the AEI. Before joining AEI, he was president and CEO of the Federal Home Loan Bank of Chicago from 1991 to 2004. Mr. Pollock focuses on financial policy issues, including financial cycles, government-sponsored enterprises, housing finance, banking, central banking, uncertainty and risk, retirement finance, corporate governance, and political responses to financial crisis. He's the author of Boom and Bust, Financial Cycles and Human Prosperity, and I believe Alex has a new book coming out this fall as well. He's a director of the CME Group, and he's on a number of boards of directors as well. He's the former president of the International Union for Housing and Finance. Please join me in welcoming our panel of experts. You can if you want. Or you can sit down, either.
Okay, I'll sit.
It's dangerous over there. Those steps are sharp.
I feel like I'm on the deck of the Star Trek Enterprise here.
It kind of feels that way. I know.
This is great. We're aiming for the future here. Great.
Whenever you're ready, Peter.
Perfect. Well, it's a real pleasure to be here. I want to give a special shout out to a student of mine, Mark Schrackman, who's here spending his summer in Washington. It's a delight to see him and all of you and to be back at AEI. It's a privilege, too, to hear from a sitting member of Congress. Congress has a bad rap, of course, right? Its approval ratings make even the most unpopular politicians seem proud institutionally. And the lazy joke is to cast aspersions at the intelligence and level of substantive knowledge of members of Congress. I think we saw something different here. And I think that's a phenomenon, too, of the way that coalitions are built generally. Whatever the partisan advantage to one policy proposal over another in monetary policy, they're going to be true believers, people who've made it part of their political mission to understand these complexities and to change them. And then there will also be those free riders who want to use an issue for strategic advantage. I was delighted to hear Representative Barr's perspective, especially as it became clear that he is a true believer. He's someone who's developed some expertise on this subject. I want to talk a little bit about where I agree with him, where I disagree, and where I think that Federal Reserve reform efforts should be focused. Where I agree is his headline point, this idea that Fed independence is a mythic good that should be defended by all good citizens everywhere is false. What Fed independence even means on any kind of concrete basis is completely up for grabs. And I think peeling back the curtain to see exactly who are the women and men who are the wizards of the economy at the Federal Reserve is an extremely worthwhile endeavor. And I salute him there. I think that that's right. But I think that there are two general ways to think about how to insert politics into central banking, monetary policy, and financial regulation. I agree with Representative Barr that the question of whether to insert politics is a fake question. Even those who defend Fed independence to the hilt recognize that the Fed is a political institution within a political context. So the real question is where and how do you insert politics into the Fed's policymaking space? And there again, I agree with Representative Barr that the goal here should be to maximize economic performance, or maximize the performance of the tasks and missions that the Fed has received from Congress. Where I part with Representative Barr is on which side of a divide you should insert politics. And the divide I'm referring to is between structure and functions. Now this is a divide that anytime you're talking about Federal Reserve reforms, you're talking about either structural reforms or you're talking about functional ones. This is probably true for institutional reform generally. What I mean by that is that when you insert politics into these functions, you can do it in a way that Representative Barr describes, which is say, we want to maximize oversight, we want to maximize transparency, we want to maximize communication. And the reason I would not, if I were a member of Congress, I would not vote for his bill is because that kind of transparency and communication that he's seeking to maximize is about forcing the Fed in a day-to-day sense, especially in monetary policy, to face not just experts who would want to re-examine assumptions and see whether or not the orientation of the Fed's monetary policy is rigorously grounded, but to become a center of public and political attention. And to our young folks in the audience, you may not remember a time when the Fed was not a center of political attention. It's certainly been that way since at least late 2007. But that's not the Fed's home turf, and that's not a comfortable space for the Fed to be. And my fear with legislating rules-based monetary policy is twofold. Number one is that it would force the Fed to say, all right, well, we're going to do monetary policy now on the floor of the House of Representatives because we're going to now have, in front of the 60-plus person member committees of the House Financial Services Committee, some backstreet driving or some Monday night quarterbacking. And that's not a dereliction of congressional duty to say that we're making an informed policy decision not to engage in precisely that enterprise. And I think what Representative Barr's bill and others like it would do is put the House of Representatives in precisely that role. So I oppose it on that basis. The second reason I would oppose it is that although it's true that this final version of the bill, does not legislate the so-called Taylor rule, it does give a preference to exactly that way of thinking about monetary policy. And that preference, right, explaining why the Fed's adopted rule should be different from the Taylor rule, is different. To defend those differences gives a priority to a rule that was written almost back of the envelope by an arithmetic calculation that looks at the Fed's own performance during 1987 to 1993. It's an awfully thin basis on which to extrapolate a theory of money. George on our panel is an eminent monetary historian, and he and I can look back, and all of us can look back and see that history is littered with the carcasses of bad monetary policy rules. Right? In medieval Korea, it was a rice-based currency. Up into the 20th century in Japan, a silk-based currency. The gold standard is a monetary policy rule. So what's better about this one when the failures have been so prominent in others? And so that kind of certainty, legislating, putting in the Federal Reserve Act, an awfully sticky statute, this certainty or this privilege on one rule, I think, is a mistake. So if that's wrong, what's right? Well, here I said it before that I jump the line between functions and structures. And I think the right way to insert politics is at the Fed's governance level. And what I mean by that, the place where Congress can exercise its oversight so effectively. And I applaud, even as I disagree with that legislation, I think introducing that it is marvelous. And the Fed's history with Congress is a history of action and reaction and pre-action in the face of legislative proposals, very much like Representative Barr's. So I think that dance, that congressional oversight, using the mechanism of proposed legislation is a very worthwhile one. But governance, I think, is more effective. And governance is more effective because it allows for those who are interested, but not those who are not, at these surgical points in time, to engage in the hard questions of who should our central bankers be, right? So governance, by that I mean just personnel. Who gets to sit in the big chairs? Who gets to pull the big levers of power? Let me give you two examples that I think have been very, very good. So one goes back a few years. Let me give you one that was more recent. President Trump, in his ineffable way, using Twitter and other unconventional mechanisms, creates these moments in time that in other eras would have been driving the news cycle for weeks or months, but today just feels exhausting just to keep track of everything that's happening. Now that has usually been a criticism lodged against his style of governance. But you'll recall in the lead up to the question of whether or not Janet Yellen would be reappointed, or if not, who would replace her, President Trump sponsored what some commentators called an apprentice-style audition. Right? He leaked a shortlist, and the shortlist included very famous people like famous, I guess, in monetary policy circles, John Taylor and Kevin Warsh, a former Fed governor, Janet Yellen herself, Jay Powell, and even some flirtations with Gary Cohn and some other unconventional choices that weren't as prominent. And some saw that as just this immiserating sacrifice of decorum and Fed independence and all that is right and good in monetary policy. Could not disagree more. The debates we had about who Janet Yellen is and what kind of central banker she has been, what Jay Powell's unique set of qualifications might bring to the table, what the Taylor rule is and why is John Taylor keen on becoming a central banker, what exactly is the nature of Kevin Warsh's critique, how is it different from John Taylor? These kinds of things were in the newspapers every single day for weeks, right? I love that. I think that's healthy. Now, did it break through to the dinner table in my hometown in Moore, Oklahoma? I doubt that very, very much. I'm reminded, George and I were talking about Catch-22 before we began, and there's this great line in the novel where Yossarian doesn't want to fly missions, and he says, they're trying to kill me. He said, no one's trying to kill you. He said, well, they keep shooting at me. Well, they're shooting at everyone. And Yossarian says, what difference does that make? Right? And I think that the public's response to the Fed is exactly that. They're making it harder for me to get a mortgage, or they're making it easier for me to get a mortgage. Well, they're doing that for everybody. Well, what difference does that make? And so the public's perception of the Fed is always going to be highly personal. And I think it's wrong to think that we can break this great technical mystery down in such a way that it can and should be digested on a day-to-day basis. And this is why that surgical approach to governance is so much more valuable than causing the public and Congress to dedicate that time with such regularity in anticipation of such hostility. That makes monetary policy a function of the day-to-day of the political process. And I think while Fed independence is no great vaunted end, I completely agree with Representative Barr there, the idea is that it serves some useful means, and that means is to let politicians focus on their comparative expertise without compromising the policy benefits of monetary policy insulation. Now let me say, I set a little timer to make sure that I didn't overspeak, so I got a couple minutes left. So if that's governance there then, including the so-called circus that President Trump ran and selecting Janet Yellen's successor, I didn't favor the outcome. I think Janet Yellen should have been reappointed. But I did favor that process. I thought that was great for American democracy. Let me give you another example. This is from Dodd-Frank. Dodd-Frank created a new office within the Federal Reserve, the Federal Reserve's Board of Governors, a second vice chair, and that's a vice chair for supervision. The idea here was that the Fed bore significant responsibility for the financial crisis in failing to adequately supervise these institutions whose failure or threatened failure brought us to the brink. And so by creating a new office, there'd be a creation of new accountability. Now, for reasons that we can get into later or not at all, this seat went unfilled formally from its creation in 2010 until October 2017. And on October 2017, there was the confirmation of Randall Quarles, nominated by President Trump to sit in this seat. Now, disclosure, I admire Vice Chair Quarles and know him personally, but this doesn't change anything that I'll say here. He and I disagree about a lot of different things on bank supervision. But for those of you paying attention in that congressional hearing, it was marvelously substantive. It was even a little bit electric. He had a big tete-a-tete with Senator Warren and other Democrats, and it just showed that Randy Quarles knew his stuff. These questions were about bank supervision, bank regulation, and there are few people in America today who have more expertise on financial regulation than Randy Quarles. Similar conversations about bank supervision did not occur in confirmation hearings before this, where the main event, the only event, was about monetary policy. I think this is an extremely healthy innovation, and the things that Vice Chairman Quarles has done, even where I disagree, there's simply no question. He is the people's choice for vice chairman for supervision, and we had an opportunity to weigh in, blunt tool though it may be, through the election, and then consequently through these televised and well-publicized hearings. So I think that's very good. The last minute, let me say something I don't like about Fed governance, and that's the Reserve Bank president selection process. For those of you who are unfamiliar with the Fed's structure, it is a tangled bowl of spaghetti. It's a committee-based structure, not unlike other kinds of committees in our government, like the Supreme Court or the commissions. But it's two different committees: the Board of Governors, which does regulatory and supervisory work, and then the Federal Open Market Committee, which consists of the Board of Governors plus 12 Reserve Bank presidents, 5 of whom have a vote, all 12 of whom get to participate in these deliberations. Who are these 12 Reserve Bank presidents? Well, we know their names after the fact. Let me give you an example. The Richmond Fed process presidential selection process was underway, and this was a doozy. And the first time in the Fed's history, the no longer serving Richmond Fed president had resigned in scandal. He had potentially committed a felony by leaking sensitive information and then perhaps lying about it to the FBI. When this was disclosed, he resigned in something of disgrace. And again, as a Fed historian, I can tell you that, we've had a lot of resignations of Reserve Bank presidents, never in a cloud of scandal like this. So you can bet that we were watching carefully, everybody was watching carefully on that selection process, who would then be the new president. More to the point, what would that process be like so we can have a little bit more transparency into the identity of this person? Sunday evening, I got a call from a reporter in Bloomberg, and the reporter said, we're about to break the story that the Richmond Fed has made its selection. And I'm a Fed watcher. This is what I do for a living, right? I'm as close to this as any outsider. And it's like, all right, great. I'm excited to comment on the virtues or failures of George Selgin if he's going to be the person or somebody else. And then they told me the name, Thomas Barkin. And I said, who? Never heard of him. Never heard of him. Now, he's a McKinsey consultant. It's a good base of expertise. I'm sure he worked on financial institutions. He'd been on the board of the Atlanta Fed. Never heard of him. And he was now, the white smoke had already come up. He was to be one of the most important economic policymakers in the nation. That's not a good way to run this railroad. And I think that having a little bit more transparency there would go an awful long way.
George?
Yes, thank you. Well, thank you, Paul, and thanks everybody for giving me the opportunity to talk a little bit about Fed reform. I'm going to start by saying that I actually might agree with Peter on Andy Barr's bill and it not being the best possible thing, but it's only because Una has convinced me that I should hold out for her alternative legislation that would scrap the Fed and start all over. I'm going to speak about a topic that I don't think gets enough attention in the broad array of topics that fall under the umbrella of Federal Reserve reform, and that's about the need to reform the Fed's operating system, which is the mechanical arrangement by which it implements monetary policy. And I'm not talking here about anything but monetary policy. I'm not talking about regulations. And I want to start by describing how the current operating system, which is called a floor system, came into being, because it's an interesting history, and it also tells us itself why we should be seriously considering whether this is a good arrangement and whether we should change it. So until October 2008, we had a regime which had been in place for quite a long time, including the whole Great Moderation period, so-called, a period of relative stability of monetary policy, where, first of all, bank reserves didn't earn any interest at all, and therefore it was costly for banks to hold more reserves than they were required to hold by law. That meant, in turn, that when they got more reserves than they were required to hold, the banks tended to dispose of them by making loans, whether wholesale loans to other banks or retail loans to hoi polloi. And the way that the Fed ran monetary policy was by targeting the rate, the federal funds rate, which was then a free market determined rate, mainly determined by what banks were willing to charge each other for lending excess reserves. So banks short of reserves would borrow from banks with excess reserves at the federal funds rate. And the Fed would implement monetary policy by deciding, for example, that if money was judged to be too tight, it would set a lower target for the federal funds rate. And the way it would achieve that target was through so-called open market operations, which basically boils down to creating more reserves, make them more abundant, so banks will lend them for the lower target rate in the interbank market. And eventually, the banks may employ those excess reserves as well to make more general loans and to increase the money supply, and that's going to that's if it judged money to be too tight. And it would do the opposite. If it judged money to be too loose, it would reduce the supply of reserves. That would contract lending. Federal funds rate would rise to a higher targeted level, and so on. So that was the old system. The switch to the current floor system was not a deliberate thing. It was instead the result of a series of accidents, you might say a comedy of errors, except it really wasn't very funny. In the summer of 2008, the Fed officials were worried about inflation, believe it or not. And they were determined to keep the Fed funds rate target at the time at 2%. Seemed like a low enough number, but in retrospect, not really. But at the same time, the Fed found itself engaged in a lot of emergency lending, which is increasing the available supply of reserves. Other things equal, that would have tended to reduce the Fed funds rate below the 2% target, thereby making monetary policy looser than the Fed wanted it to be, and according to beliefs at the time, perhaps causing inflation to get worse. So what did they do? Well, for a while they did something called sterilizing of their emergency lending, which meant the Fed would sell as many assets off its balance sheet, treasury bills, as enough to offset the emergency lending it was doing, so the total reserves in the system would not go up despite the emergency lending. That went on until September 2008. At that point, the two things happened. The volume of emergency lending went up with Lehman's and then AIG, went up a lot. And the Fed's portfolio of Treasury bills was had declined to a minimum level as far as it was concerned. So it couldn't sterilize anymore. It was then that the Fed sought permission to start paying banks interest on their reserves, which it was going to be able to do in a couple of years, but now it wanted to do it right away, for a very unusual purpose. The purpose was to encourage banks to hoard any new reserves that the Fed created, so as to keep them from lending those reserves either in the interbank Fed funds market or otherwise, to maintain the targeted Fed funds rate, which on the same day as this legislation came through was lowered finally to 1.5%, and now they wanted to hold it there. So the idea of interest on reserves was to keep monetary policy tight despite reserve creation that was at the time an unintended byproduct of emergency lending. You might say that the Fed created a bespoke liquidity trap. That is, at what was originally about 75 basis points, they said, we don't want our reserve creation to do anything. Well, of course, by December or November, the Fed was no longer worried about inflation. They were worried about the need for stimulus. And it's then that they decided that they needed to create plenty of reserves, not as a byproduct of emergency lending, but deliberately to stimulate the economy. But they had put this interest on reserves mechanism in place, and that meant that the banks were going to hold all the reserves that were given to them. Under this arrangement, this floor system, monetary policy is no longer a function of how many reserves the Fed creates. It's a function of where it puts the interest rate on excess reserves. So that becomes the new policy instrument that determines how tight or loose monetary policy is. In this floor system, there's no interbank lending to speak of. There is some federal funds activity for other reasons, because some institutions can't get interest on reserves. But monetary policy is no longer determined by how many reserves the Federal Reserve creates. This turns out to have become a problem as the need for stimulus, for monetary stimulus, became more and more important over the course of late 2008, 2009. It's interesting that how the Fed presented this change, has presented this change in the floor system, regarding it as a virtue rather than a necessity. Presenting necessities as virtues is something of a Fed specialty, I should point out. But in this case, the way they made a virtue of it was by saying, oh, look, with this new setup, we can separate the size of the Fed's balance sheet and the amount of liquidity it creates from the stance of monetary policy. And that's great, because it means now we can separately determine how much reserves, how much liquidity we want the banking system to have, and determine the stance of monetary policy by setting the interest rate on excess reserves. Well, okay, that sounds good, but think about it. It's analogous to the following argument. Think about an automobile, right? I have an automobile, and you have two controls, the steering and the throttle, the gas. The problem is that you can't just independently in an ordinary automobile that's in gear, you can't steer the steering wheel any way you like and step on the throttle as much as you like, because under certain circumstances, certain combinations of those things are going to get you in big trouble. What if you could have a car where you were absolutely free to step on the gas all you like and steer any way you like, and everything would be fine, you'll never crash? Can you do that? Yes, you can. How? Put it in neutral. What the Fed's new arrangement did was to put monetary policy in neutral. They could step on the reserve creation gas all they liked and set the policy stance with interest on reserves as a steering at any level they liked. Those things weren't connected to one another. That's the good news, and that's what they're ballyhooing or trumpeting as advantage of the system. The only problem is monetary policy doesn't go anywhere. Or at least, if you want it to go anywhere, you have to really step on the gas, which is creating trillions of dollars of reserves to achieve what billions would have done under the old operating system. Indeed, Ben Bernanke himself said that quantitative easing, which is his name for massive reserve creation, works in theory. It doesn't work in theory, but it works in practice. Well, what he meant was that there were some empirical studies that showed that interest rates would be affected by large-scale asset purchases or quantitative easing. But the more economists study QE, the more they find that that's about all it did. If you look for employment effects, you look for output effects, then the evidence becomes rather scant and therefore more consistent with what the theory says should happen, which is not much. Okay, so that's one problem with the new operating system. It makes reserve creation ineffective as a means for monetary stimulus. But there are many other problems as well. There's less market discipline, and that's because without banks routinely lending to each other in an unsecured market, in this case the Fed funds market, they have no incentive to monitor each other, and that means that you have a greater risk of contagion and as well less information about banks' safety flowing from the banks that have an incentive to gather it and monitor it to the financial community as a whole. There's a huge literature about the importance of interbank lending because of its monitoring role. The new system is highly inefficient. Banks have a very high and practically insatiable demand for excess reserves under this system, but to the extent that they accumulate excess reserves, as they've done since 2008, they are lending less. They're lending obviously less in the interbank market, but they're lending less more generally. For many, many years before the crisis, loans of all kinds, loans and leases of banks, were approximately 100% of deposits. Excess reserves were 0% of deposits. Now the figures are 80% and 20%. And this is not a free liquidity lunch. What it means is that the resources that were being steered towards other borrowers that were servicing regular bank loans are now going to service those assets that the Fed is accumulating and that are being financed by these holdings of excess reserves. So you have this big increase in the Fed's credit footprint, and that in turn means a drag on productivity because the Fed is not a productive lender. The Fed's choice of assets, and this gets to the allocation issue that Congressman Barr raised, the Fed is not in the business of choosing productive assets. And indeed, all kinds of factors go into the assets it holds. We certainly wouldn't want the Fed to be trying to be a regular banker. God knows what would happen if we did have it do so. But we aren't going to get as much of a boost to economic activity, generally speaking, from the Fed's asset accumulation as we would get from the accumulation of interest-earning loans from other institutions. 1 minute, Lina. Okay. There's a bigger risk of entanglement with fiscal policy because now you have a balance sheet that's a free parameter. So if people want the Fed to finance their activities, then the Fed can't say, oh, that would mean loosening monetary policy and causing inflation. It's no longer true. Finally, the system isn't legal. The 2006 Act that it's originally based on calls for the interest rate on excess reserves to be set at a level no higher than corresponding market interest rates, which is impossible with a floor system. It has to be higher so that reserves have no opportunity costs. Okay, so in any event, we should have a discussion about this operating system, which we got into accidentally, so we never had a discussion getting into it. We should have a discussion about whether we should get out of it and return to a more conventional system, a corridor system, where the interest rate on reserves is a more modest level. And by the way, this is the system that has been chosen by most central banks elsewhere, including some that briefly flirted with floor systems like ours. They discussed whether they should keep them or not, and most of them have gotten back to or adopted corridor systems.
Thanks, George. Aaron?
Thank you, Paul. Good morning. Good morning. So, first I want to thank Paul and AEI for having me here and having such a diverse intellectual panel. It's really a credit to the institution. I think one of the things you'll hear as a potential common refrain from the speakers here and the congressman is everybody thinks there's something wrong with the Federal Reserve system, but we kind of disagree both on what the problems are, the objectives are, and the solutions. And it leads one to kind of appreciate how you can continue to have the stasis around a system that nobody seems very happy with. Part of being on this panel, I think, is an opportunity to react and offer where I think things are right and wrong as to what's been said before, and also to propose a couple new ideas and highlight a few new problems. So let me start moving from my left, which is where I'm most comfortable, with George, and say, George, you're exactly right. I was in Congress when we put in the 2006 law allowing interest on excess reserves. Reserves were tiny. I mean, you're talking about, less than 1% of what you have today on the Fed's balance sheet. Nobody ever imagined that you'd be dealing with numbers as large as what we have right now. I can prove that not only by collective staff memory, but also by an interesting fact, which is when we put the legislation in, the Congressional Budget Office had to do a 10-year projection on the cost of that. And how the Congressional Budget Office calculates the Federal Reserve is like 1/8 science, 6/8 art, and 1/8 magic. And in the process, they said, it's really not going to cost anything because what the Fed pays out is going to be so minuscule. And now you're looking at the orders of hundreds of billions of dollars on an annual basis. And they said it would be, I think, $50 million over 10 years. Nobody saw this coming as a major tool of balance sheet. And so the idea of having a conversation about it now that it's used in a totally different context is correct. When we accelerated the date during TARP, because that's what it was tucked into, it was much more like all hands on deck. There's a crisis. You have an emergency patient. Make sure the doctor has access to all the tools available. And we'd already given them this tool. The effective date was delayed. So why not? But again, it was in the much broader context. Second point I want to kind of correct the record on has to do with a little bit of what the congressman was saying about congressional appropriations. And make no mistake about it, the Federal Reserve often uses its need for independence and secrecy in monetary policy, which the Fed has made tremendous strides on. It wasn't, when I was in school, the Federal Reserve didn't even tell the market what it did on interest rates. There's a whole occupation devoted to measuring the size and width of Alan Greenspan's briefcase, because there was a belief that the wider his briefcase, the more likely a change in the Fed funds rate was. Bert's laughing because he remembers this. Markets moved on somebody putting a telestrator and a ruler on a briefcase. And I think my former colleague at Brookings and my former professor at Princeton, Alan Blinder, deserves a lot of credit for coming in as vice chair of the Board of Governors in the 90s and really pushing the Fed to be infinitely more transparent in its conduct of monetary policy. That desire to have more transparency in regulatory policy has been fought, often with a little jujitsu of we can't tell you what we're doing in regulatory policy because we have secrecy of a culture in monetary policy. That being said, the answer to that is not putting anything on congressional appropriations. What that functional tool of congressional appropriations does is allow special interest capture, particularly with regard to small riders on large appropriations bills, to serve often the interests of industry. It is the rationale why no federal bank regulator is on congressional appropriations. There was one regulator that was on congressional appropriations. It was the regulator of Fannie and Freddie. And I feel like being at AEI, it's only fair to say that ended really badly. And congressional appropriations was part of that. And in point of fact, under Republican Congress and with the support later of President Bush, legislation was done to put their new regulator off of appropriations. So that is a huge mistake as it relates to the Fed, not just on a question of independence, but on a question of, do you want to have independent and tough regulation, or do you want to allow a more easy proxy for industry capture and pushback of regulation? Now, that being said, I want to then talk where Paul kicked us off. You had a really cool laundry list of things the Fed kept being added to. I do want to say, as a statement of fact, my former boss, Senator Dodd, tried to shorten the list. The original bill that became Dodd-Frank, called RAFSA, removed from the Fed a series of authorities as it related to small bank regulation and supervision, and tried to narrow it. Say, we understand in Dodd-Frank we're going to ask the Fed to have this broader systemic mandate, so let's narrow the mandate a little bit and take away something. That amendment was defeated 90-10 on the floor of the United States Senate. Every single Republican, plus the majority of Democrats, teamed up to defend that. And they defended that on the basis it was an amendment by Klobuchar Hutchinson, right? Shows you that not all bipartisan things may necessarily be good. And it said, well, you can't do that because the regional banks are incredibly important because they have unique knowledge in the region and they need to continue to regulate their small member banks. So I agree with the critique that the Fed's mandate has grown too large, but I point out that when there have been congressional attempts, everybody who likes their little part under the Fed comes back and fights, often in substantially large and successful political coalitions. Second point on that point. In the long list of things you said, I didn't hear payments and the nation's payment system. Was that right?
Yeah, I didn't find it in the laws I looked in.
Right. The Fed regulates the nation's payment system and operates it, and that's a giant conflict of interest. We have one of the worst and slowest payment systems in the world. The United Kingdom developed real-time payments when the first iPhone was introduced. We're on the iPhone 10, and your check takes 5 days to clear in the U.S. In England, we would transact and clear and settle money immediately. Poland got real-time payments. Mexico got it in 2004. We can build a wall, but they're going to be moving their money a lot faster than we can on our side of the wall. South Africa has real-time payments. Japan got real-time payments in 1973. This technology has been around and been globally adopted. Why does the United States have it? Not have it? 2 reasons. One, the Fed doesn't really care enough to devote substantial resources to breaking some of the eggshells to make it happen. Why doesn't it care? Well, I'll tell you. 40% of Americans never touch the zero lower bound of their bank account. That includes me, and I'm going to guess most people in this room. About 60% of you touch what I call the zero lower bound. That is, if you look at national statistics and you come up with $400 in emergency, you look at JP Morgan's data on income volatility, are you going to hit near zero on any given month over the course of a year? It's true for about 6 in 10 Americans. I would gather of that 6 in 10, about 0 are affiliated with senior level roles in government, like myself. Again, I'm part of the 40%. So we don't see this zero lower bound issue. When you start touching the zero lower bound in America, you have overdraft fees, you need small dollar credit. The cost of basic financial services skyrockets if you touch the zero lower bound of your bank account, to the tune of billions of dollars a year taken out of the economic well-being of working and middle-class families and transferred into the financial services sector. This is a solvable problem to a decent degree based on technology of time of funds settlement. The number 2 complaint among banks, according to the CFPB, was that their check didn't process fast enough of all consumers, leading to overdraft fees. Now, a little bit of, to give the Fed a little credit, they see this as a problem at some various level, and they created a faster payments task force. That faster payments task force had 331 members. Can you imagine ever agreeing to do anything faster if you have a committee of 331? This is what I meant about prioritization.
Smaller than Congress.
You need a real-time task force.
Right. And this gets to prioritization. Who wakes in? I interviewed Fed governors and governor candidates for a decade, both in Congress and in the administration. Of everybody who was going to be a governor, only one of them ever indicated an interest in payments. It's not even on the list of that Paul gave, which is a pretty long list. But it's vitally important to millions of Americans who are, in my opinion, underrepresented by the Fed. So let me try to tie these two thoughts together and pick up on Peter's last comment about regional banks. Because regional banks operate the payment system. Regional banks are supposed to represent their region. This idea that was created in 1913 was America's third central bank. Right? That's what the Federal Reserve is. It's our third crack at a central bank. Was to balance New York and moneyed interests with the interests of the people, and they created these regions that were roughly equal in population at the time. Today, Minneapolis has, I think, 3% of Americans, and San Francisco is crouching on 30%. So the regions have become... But we were going to have people from their region, and we were going to have people to create independent voices. And this is the question about what I consider one of the Fed's potential problems is groupthink. And the ability, I think it was either George or Barr said the Fed kind of missed the crisis in 2007, in part, I think, because of a lack of diversity and a reliance on groupthink. So I'm going to put a couple slides up here. These are the 12 sitting Fed bank presidents. How many of them are from the Fed? Everybody in blue. And I define from the Fed as having worked for the Federal Reserve, either at a regional bank or at the Board of Governors, or having served on their board of directors, right? If you're on the board of directors of a company, you're part of the company. If you're on the board of the directors of the Fed, you're part of the Fed. So let's hold San Francisco. They have an interim right now, so it's a little unfair to call them one of the 12. I count 9.5. So you can see that 9 of the other 11 are just very clear, right? The half is Robert Kaplan from Dallas. Robert was not part of the Fed. He was not part of the Dallas board. He was on the board of the search firm hired by the Dallas Fed to find the next president. This gets to this selection problem. The Federal Reserve tends to have an interesting selection process in which the Federal Reserve insider is almost always selected. Now, I actually tend to think from enough independent analysis and some public and non-public data, they actually do a decent job of identifying some robust outsider candidates. They're just never selected. One counter of that is Minneapolis. Neil Kashkari, no relationship to the Fed. I disagree with Neil on a lot of policy and substantive things. But I think he's an awesome governor, and I think it's fair to say he's the most diverse of the governors in terms of method, communication outreach, and often, a willingness to engage with the public of an alternative vision and bring that alternative vision to Washington. I don't think that's uncorrelated with the fact that he's the only person here who didn't have a connection to the Federal Reserve or the search firm hired by the Federal Reserve. Point 2, no conversation about diversity on the Fed system, and the problem in structural diversity in the regional banks can be had without stating an obvious fact. America elected a non-white president of the United States of America before the 12 Federal Reserve banks had a non-white president. Think about that. There were about 131 chances these 12 banks had to select somebody. Right? America got to 44 of the presidents. It's also interesting to note there have only been 6 women in the history of the Fed. There have been 9 on the board. There have been 3 African Americans on the board. The Federal Reserve Board was first integrated in the 1960s. So this is a unique problem to the regional banks. And I'm going to add 2 other factoids, because sometimes you don't get a large enough numbers to run a robust statistical analysis, but I think these data are illustrative of the point of problems of groupthink and capture of the appointment process. 1 minute? All right. There have been 6 women. 3 are from Cleveland. There were two Asian Americans, both from Minneapolis. Atlanta finally had an African American president. A little bank can go a long way. So I got to put my second slide. The purpose of the Federal Reserve Banks, and we heard this in Klobuchar Hutchinson repeatedly, is to bring knowledge from the regions. Okay, are they from the regions? Green are people from the regions. Brown or beige are people can't identify any connection with the region that they've been appointed to run, including the Richmond president who chaired the Atlanta Fed Board. I'm from Maryland. I'm in the Richmond region. There are a lot of talented people in Maryland and Virginia and D.C. to pick. If you want regional expertise, if the purpose of having 12 regional banks is to have regional expertise, you would think that they could find somebody talented in their region. Yet the majority of sitting presidents of the Federal Reserve regional banks had zero experience living, or as I can tell, connection to. They weren't from the region. They didn't go to school in the region. Who's selecting these people, and on what basis and criteria? Because if the criteria is from the region, it isn't. If the criteria is, are you from the Fed, it's a pretty good track record.
Thanks, Aaron. Alex?
Thank you, Paul. Ladies and gentlemen, I'm going to talk about 4 issues on the Fed today. The Fed's inevitable knowledge problem, 2% inflation forever, the expropriation of savers, and the Fed and Congress. On the first point, in January 2008, Ben Bernanke, then chairman of the Fed, of course, made this remarkable announcement. The Federal Reserve is not currently forecasting a recession. As we all know, a very steep recession had already started by the time the Fed announced that it wasn't forecasting one. And this is just one of many forecasting failures one could make about everybody. But think about the list of responsibilities, all very high-sounding, that Paul so beautifully summarized at the beginning.
Alex, the August 2008 Green Book, which is the policy brief that goes to the FOMC, predicts 2.9% growth in 2009. That is a public document. You can read it. So in August, right before Fannie and Freddie failed, the 2.9% growth next year.
Another great example. Thank you. And there will be many, of course. The point is, think of that huge list of amazing things that are supposed to be done by the Fed and compare it to the knowledge problem they actually have of not knowing what is going on, let alone what will be going on. Because, of course, we know for everybody the financial and economic future is not only unknown, but is unknowable. And that's true for the Fed as for everyone else. So my point isn't that the Fed is particularly bad at knowing the future. They're equally bad as everybody else. They're not any worse, and they're not any better. And yet, the Fed keeps insisting, as do its fans, that this independence, which we have all talked about, is something important. It's part of the confession of faith of the Federal Reserve that it ought to be independent, to be an immensely powerful fiefdom, answerable only to its own theories, which of course change from time to time. And that is really an astonishing claim if you contrast it to the knowledge problem anybody, including the Fed, has when it comes to knowing what's going to happen. So this desire to act as independent economic philosopher kings, we might say, in my view, can only be based on a claim to superior knowledge. And this superior knowledge, the Fed demonstrably does not, and moreover cannot, have. So its claim that it ought to be independent is utterly unconvincing outside of Peter's point that it's impossible anyway, actually, for part of the government to be independent, and the Fed is part of the government. Now, coming to inflation targets, we of course can't help observing that there is, at least among very many people, a strange faith in the Federal Reserve. Perhaps it has to do with not looking behind the curtain as the Wizard of Oz operates from back there through his loudspeaker. But for example, it is endlessly repeated in the journalistic part of the world that an inflation rate of 2% a year must be good because it's the Fed's target, without wondering whether this is a good idea. Now, of course, some people have skeptically considered this question. For example, Olivier Blanchard, formerly chief economist of the IMF, has stated, quote, "There's no sound economic research that shows 2% to be the economically optimal inflation rate." Alan Greenspan, when asked what the right inflation target was, said 0, adding the wonderful Greenspanian hedge, if measured correctly, which is marvelous. But a remarkable thing about the Fed's current idea of an inflation target is that it is in perpetuity. This is 2% per year forever. Forever? How can any of us commit to thinking that something should go on forever? Now, in an expected lifetime of 82 years, at 2% a year, prices will quintuple in a lifetime, and yet the Fed, keeping a straight face, calls this price stability. It also often claims that price stability is one of its statutory mandates found in the Federal Reserve Reform Act of 1977. But the Federal Reserve Reform Act of 1977 doesn't use the term price stability. It says stable prices. The Act most certainly does not say a stable inflation rate. It says stable prices. So what does the term stable prices mean? Does it mean perpetual inflation? We learned from the minutes of the Federal Open Market Committee that in 1996, when in an early debate about whether the Fed ought to have an inflation target, one member of the committee dared to ask what Congress thought, what the congressional mandate of stable prices meant. What did Congress think they meant when they wrote that term? And in the Open Market Committee, this question was quickly passed over and not pursued. Obviously couldn't be too relevant, but it was a good question, wasn't it? And in fact, we have quite a good indication of what Congress's thoughts were in the act of the next year, the Humphrey-Hawkins Act of 1978, which states, and I quote, that the Federal Reserve will have, quote, the goal of achieving by 1988 a rate of inflation of 0. Obviously, this was not achieved, and somehow we don't hear the Fed discussing this goal as expressed in statute. Now, 3, let me come to savers. The Fed has a knowledge problem, as I said, but savers have a Federal Reserve problem. Most of the time since 2008, the Fed has imposed negative real interest rates on everybody, but on savers in particular, with an extremely low, nearly 0 for many years, nominal interest rate, but a real interest rate which has been almost all the time and is still negative. Now, the Fed's point in doing this was to transfer wealth from savers to borrowers, and in this they have notably succeeded, as they have extended this policy, which is very arguably correct in a crisis. But the crisis has been over for going on 8 or 9 years. And by extending this financial repression for a decade, by our calculations, the total transfer from savers to borrowers is $2.6 trillion. $2.6 trillion is a reasonably sized amount of money. And I'll be glad to share the calculation of that with anyone who might be interested. Now, note that the borrowers enjoying this largesse include highly leveraged speculators, any kind of leveraged financial institution, hedge funds, and similar organizations. Now it's obvious that to take $2.6 trillion from some people and give it to other people is a political act. And as was rightly said, you cannot separate the question of money from politics. The question of money is inherently a political question, a philosophical, eternally debatable question, and this is going to bring us in a moment to the role of the Congress. Now, we know that the Fed justifies the sacrifice of the savers as promoting the general good and the greater good as it conceives it, but it seems to me that it should at least fess up to the Congress about what the trade-off involves if you're going to sacrifice savers. So I believe the Fed should be required by the Congress to include in its regular reports to Congress what we could call a savers impact statement, and just have an open, realistic discussion of, look, this is what our policy is doing to savers. And this, I believe, would be a good balance against the usual concentration of monetary policy on what we're doing for borrowers. And speaking of borrowers, remember that the biggest borrower of all, the biggest beneficiary of negative interest rates, and the biggest beneficiary of the Fed's quantitative easing problem is, of course, the government itself. And one of the biggest effects of quantitative easing is a credit allocation to the government itself and its deficit. And this shouldn't surprise us if we think about it, because the original reason for the existence of central banks, and still their top priority, is to finance the government of which they're a part as needed. And that's another reason why questions of money and credit are inherently political questions, and therefore should inherently involve the elected representatives of the people, as Congressman Barr said. And this brings me to my final point, which is governance and the Congress and the Fed. Now, Ben Bernanke advised his successor, Janet Yellen, always to remember that, quote, Congress is our boss. But does the Fed really believe that, or at least do they believe that should be the case, that these mere elected representatives of the people should have anything to tell high-powered intellectuals and experts like us? Now, just to make this bipartisan, it used to be the case that the Democratic Party was the party that stressed the accountability of the Federal Reserve to the Congress. Former Senator Proxmire once put the case in congressional hearings, and some of you may remember the case he was making was he wanted to force the Fed to promote housing, and he said to the Fed representative in a hearing, "You recognize, I take it, that the Federal Reserve Board is a creature of Congress. Congress can create it, abolish it, and so forth."
So, Alex, I'm going to bring you to a halt for here because we need
some time
for the audience.
Can you give me 30 more seconds?
23 more seconds.
23 more seconds. Thank you. I thought I was going on 15 minutes, but I will finish here quickly. So my view is that we ought to think about the Congress and the Fed in the same way one thinks about a board of directors and the management of a company. And the conversation that Congressman Barr was trying to get, a reasonable conversation, a grown-up conversation about monetary policy and what the Fed is doing or not doing, should be modeled, or one might think about it's being modeled, on the way you'd want a management and a board of directors to interact with each other. And we might get, as Congressman Barr hopes, something productive out of that. Can we imagine that? Well, as Paul's historical summary made clear, in the long history of the Fed, many things have happened which were previously unimaginable. Maybe this can too.
So, as you can see, great discussions by everybody. We could spend all day talking about this, and many of us probably would enjoy that, but we have a time a short time. So why don't we take 1 minute to react to either finish up what your thoughts or react to your colleagues on the panel here. Peter?
Great. I agree with Aaron that this is an ideologically extremely diverse group, and so I'm a little bit more disappointed that I don't have more to disagree with. George really has been at the forefront of bringing interest on excess reserves as a serious question, and I wish that we had the very conversation in a much more public way that George is proposing. And Aaron is just 100% correct. One thing this panel lacks is diversity along other parameters. The women were all white, and that is appropriate, sadly, for conversations about the Fed and its governance structure, as Aaron indicates. And the payment systems, I just again completely agree, just monumental importance. Last thing I'll say in 10 seconds is Olivier Blanchard was making that point in favor of changing the 2% inflation target to 4%. I wonder if Alex is now doing the same.
I know he was. That's why I love the irony of using the quote.
He's implicitly endorsing. You heard it here first, folks. Alex Pollock for 4% inflation.
Alex Pollock for not anybody's ability to know what the numbers should be.
George, quickly.
Yes, well, I share Peter's frustration with the fact that I can't climb all over any of my fellow panelists for having said anything I strongly disagree with. I've steered clear from the whole question of independence that is, of course, a very central question in my own remarks. But of course, I do think that at the very least, it does not mean that there should not be open debate and public discussion about the Fed's actions, policies, frameworks, etc. All of this should be fair game. Furthermore, I would say that none of that sort of thing has anything to do with telling the Fed how to run monetary policy on a day-to-day basis. Although I must say I don't think that Congressman Barr's legislation would in fact have that effect. I was really glad to have Aaron mention the payment system as sort of the elephant in the room. I'll just say that the history of how the Fed muscled into the payment system and to taking control from what were, at the time, very efficient private clearinghouses is well worth looking into for those who are interested in putting a critical eye on the way the Fed does the job today. And I'll stop there. I'm sorry I didn't get to react to Alex's remark.
So if past is prologue, ironically enough, financial institutions are doing more to put in real-time payments in the United States than the Fed ever has. If you see Zelle or some of these new things that are going, it's not because they're actually cannibalizing their own revenue stream out of a fear of being Uberized. I'm off to China next week where people pay not through the banking system and it's instantaneous and widespread adopted, and it's all from this little device that all of us have in our pockets that doesn't have a mag swipe card on the back, but rather is a phone. In the interest of being a little more provocative and mixing it up here, even though I agree with a lot of what different people said, I'm going to use the remainder of my 30 seconds to kind of disagree a little bit with what Alex said. The definition of savers you use is implicit and not stated. I assume it means people who deposit at banks, not people who invest in the stock market or other forms of asset prices which have been greatly inflated as a result of monetary policy in a way that has skewed economic value to holders of existing assets. I think one of the better critiques of quantitative easing that I've not heard on this panel is the idea of its impact on income equality and inequality. And one of the areas where I would disagree with some of my folks that have stated before is I'm not sure the Fed's goal is to maximize total economic output. I think there's a distributional question. I'm not sure society's role and government's role is to maximize total economic output. Economists use that as a proxy for utility. But obviously that's not correct, right? There's sovereignty and personal liberty that we would trade off on that. Whether or not you agree or disagree with England and Brexit, they traded off growth for sovereignty. That's not an illogical choice. unless you believe in GDP. Sorry.
That was a long 30 seconds.
Thanks. Aaron is right. When I'm talking about savers, I'm now holders of conservative money-like instruments who have indeed been expropriated. Of course, holders of leveraged real estate and equities have done very well as part of this, as the Fed's monetary activities have created asset price bubbles, a serious problem. I wanted to mention just one other thing, which is this question of being subject to congressional appropriations. Peter Conti Brown makes the point that if you think about one of the sources of the Fed's power, it's its complete budgetary independence, which it gets from being able to run huge profits, which happen automatically because you own investments financed by monetization, and the ability to spend completely in an uninhibited way out of those profits before they give 99-point-something% back of them back to the Treasury. And that is a very interesting structural element in the problem. Now, whether you want to address it by appropriations or not is an interesting question, but the fact that the Fed has this great budgetary independence is without question.
Let me just have one fact. The majority of Fed spending is from the regional banks, not the board.
Yeah, okay. Let's give our audience a chance to ask you guys the hard questions since you didn't gang up on each other. Let's let our audience take. So please state your name and keep it to a question, and your affiliation, and keep it to a question, please.
Thank you. Chris Condon, Bloomberg News. I'm wondering which of you would favor changing the status of the reserve banks, which are, of course, legally private institutions, to be public institutions. Would that resolve any of the problems you're talking about? Would it introduce new problems? Thank you.
Who wants to take that one?
Well, you're questioning, of course, the original deal. This is the Woodrow Wilson's great 1913 compromise in the creation of a federally structured Federal Reserve. I wouldn't characterize the Federal Reserve banks as private institutions. In the words of Justice Bone in an old Federal Home Loan Bank case, the shareholders, he said, of the Federal Home Loan Banks, but it's true the Federal Reserve Banks own the shares of the Federal Reserve Banks, but they do not own the banks, and they do not control them.
So I think they are private entities. I think that's legally established. I think that putting them as public entities solves some problems and creates others. And so I'm not sure that on net, I'm not sure whether or not it's a good or bad thing. I think you could potentially get some of the benefits, FOIA, allowing the Fed's IG, which is legally prohibited from investigating a lot of the spending at some of these regional reserve banks. A lot of these questions, I think they're surgical things you could do to improve it. I'd be open to it. It's a complex trade-off.
Let's take another question. Over here. Wait for the mic, please.
Hey, good morning, everybody. Thank you for being here. My name is Sahan. I'm just enjoying summer until I go to grad school this fall. So I just wanted to ask. I know you mentioned a little bit about income inequality. Isn't the current interest rate system, like the lower interest rates or even negative interest rates, potentially create an even? Isn't inequality currently one of the big reasons? Is because our interest rate situation right now, because Wall Street can borrow enough money to speculate, whether if it's hedge funds or even on real estate assets, while the person in middle America who works hard, he can save his money, but he's not going to get much of a return on it. And also, this velocity of money is going to be decreasing because 99% of people are savers more than speculators. They're going to be unfairly affected. No. So isn't this interest rate environment creating a more unequal society right now?
Well, he can speculate on a house in a highly leveraged way, but it may turn out to be a mistake.
Most people are debtors. Most people's balance sheets are negative, particularly when you include their mortgage. There are very few people that are net savers. Those tend to be highly correlated with wealth.
I think that one... sorry, George, if you want to say
No, go ahead, Pete.
This is one of the searing critiques that some have made about the way that central banks have approached the post-crisis environment, which is that they had the right directional instincts, but they were too weak-willed to really deliver. So focusing on things like NGDP targeting or significant negative interest rates that are short in duration would result, if you were to, not to invoke calculus this early in the morning, but if you were to integrate the consequences of this kind of policy, looking at the net gains for everyone, then acute negative interest rates or dramatic NGDP targeting in the short run would be much better off than what you see is just a long, chronic environment of low interest rates. So that's at least consistent with that.
I want to add one thought to that. So to the extent, as Alex pointed out, that the biggest beneficiary of negative interest rates is the government, and if the government takes that money and spends it back on poorer people, if you take a bigger picture, it's not entirely clear that the tax on the savers, which are wealthy people, as Aaron points out, isn't actually being redistributed to the poorer people through government spending. I'm not saying I have done that calculation, but I'm just saying it depends on where you're looking at it from. Are you looking at it from, and when you look at your bank statement, are you looking at it from, the space shuttle on the overall effect? And let's take one more question. Why don't we go to the lady behind Bert there?
Hi, my name's Quenby Wilcox, and I'm with Global Expats. And I've been looking at banking systems more internationally than, a lot of things that I've been hearing here, I'm very interested. I'll be blogging about that. But, and I've been critiquing a lot the IMF and their problems. But one of the things that I've heard is across the board is governance. And this is one of my criticisms of the IMF, this group think and everything. And really the problem here is a human resource problem and within the HR departments. And a lot of the problems that have come with the failure of human resource departments to implement progressive human resource theories is the alpha dominance feminism movement. So any of you have any thoughts about, how all of these institutions, there's a groupthink problem? And any thoughts?
George, I think your background in zoology, groupthink, the animal, is this a characteristic of all gazelles all go the same way?
All my classes were about other species. I don't really understand human beings.
I would say to the question that all groups are subject to groupthink, period. And one of the problems we always confront is particularly related to uncertainty. When faced with high uncertainty, there's a tendency to want to think the same thing that others think because inside you're so uncertain, and it makes you feel better if you're doing the same thing that other people do. And this certainly applies to central banks. If you watch central banks internationally, you find they all start to say things that are the same, and they all start to do the same.
I think it has less to do with HR departments and more to do with international organizations like the Bank for International Settlements, where all the central bankers go to meet every month to discuss policies and analyze the world, and you tends to be a club where everybody gets the same ideas and things like that. And economics certainly has this fad and fashion in the articles we write and publish over time. And
for sure. The only point I want to make is I think it's highly correlated to uncertainty. When faced with high uncertainty, there's a bigger, in my opinion, tendency to want to think the same other people do. Ask your friends and see what they think. And one of the things that has the most uncertainty is the financial and economic future. And therefore, it's hard to avoid another term for this would be cognitive herding.
In other words, the less people know what's going on, the more they agree on what's going on.
I think there's a bit of a culture issue. And if you went back to the slide, if you had fewer blue box, in other words, if the path to getting ahead was not to be part of the system, and the system rewarded external out, it's very hard to shake up groupthink when you continually promote within. It's as much of a problem at the Federal Reserve regional banks as I think it is at Wells Fargo.
And business, the consensus economic forecast, everybody wants to be just close to the consensus. I need to look over here because I've been looking that far, so I need to get to this side of the room. Let's get another question from over here. How about the lady at the table back there?
This is for Alex Pollock, who I greatly admire, but I was I was a little taken aback by your suggestion that Fed independence is primarily grounded in the idea that they're experts and know the future. Completely agree with you, they don't. But my understanding was that the real ground for Fed independence was because there is this perceived to be a pervasive populist desire to keep interest rates low, which could lead to inflation. As I once asked Larry Lindsay if the Fed independence was a problem or likely, and he said no, because then we would have no one to blame, or they would have no one to blame. So I wonder if you could address that as also a good ground for independence.
That's a very witty answer by Larry Lindsay, who's a very smart man. Well, we now have the Federal Reserve itself as the biggest purveyor of low interest rates, this presumed populist opinion. And what happens when you get an inflationist Fed confronted with an anti-inflationist Congress? That's the opposite of the story of what always must be the case.
I think we should perhaps, I'd like to push back a little bit on this assumption that the interest rates are low because of Fed policy. There are lots of reasons why interest rates are low, and let's recall that quantitative easing, at least as far as I can tell, and my understanding of the interest on reserves policy, that it just doesn't ease the economy that much. It has not had that long a big an effect. And of course its effects wear out, and it's now been many, many years since most of the expansion took place. It's hard to believe the Fed has been capable of holding interest rates artificially low for that long. And they're low, let's notice, everywhere in the world, not just here. So there's a real question to what extent interest rates are low as a result of the Fed's activities as opposed to other factors, particularly low productivity and low, which is determining keeping real rates of return low.
One more quick question. Norbert?
Thank you. Norbert Michel, Heritage Foundation. This question is basically for Peter. If I understand you correctly, one of the problems that you have with the Form Act or some version of that is tying Fed policy to the Taylor rule.
Yeah.
So if the legislation instead said something like, look, we don't care what metric you're using to set policy as long as you say what it is, and we don't even care if you deviate from it as long as you tell us why you're deviating from it. Are you okay with that version of transparency and accountability?
It's a great question, and it's good to see you again, Norbert. So that would satisfy the second of my criticisms, right? That the idea of, well, what about rice-based currencies, right? And John Taylor, to his credit, has said, yeah, I'm very comfortable with that kind of approach. Don't make the Taylor rule. Don't even refer to it in the legislation. It doesn't satisfy the first, and that is when you can have, at the invocation of a committee chairman, that holding the feet to the fire in real time, in monetary policy real time. And of course, any congressional committee can do this at any time, any way. But having the inertia behind those kinds of scheduled every 6 weeks interfaces makes me nervous. It makes me feel like then that becomes monetary policy by a congressional committee. And if we want that, then maybe we should do that. And the Fed, says Ron Paul, for similar kinds of reasons. And that's why I think the kind of accountability you're looking for, others are looking for here, can be effectively exercised through the personnel and governance process without introducing those same kinds of risks.
As somebody who's been deeply moved by and agrees with Alex's point about the humility of knowledge, I think putting any rule forward presupposes more knowledge than we have. The biggest concern I have with the Fed is not their deviation from rules, but their inability to deviate from their models, which, as we pointed out, got the single biggest question, the financial crisis, totally wrong. Their model didn't even have an input for a financial crisis when you turned under the hood. So I think the more you put models forward, the worse off you are. I would almost rather go to the opposite.
So, again, I have to pull away the punch bowl. Peter, George, Aaron, Alex, great discussion. can you join us in thanking our panelists today? And we should do this again sometime.
That was fun.
Yeah.